Here now, John Hilsenrath, Wall Street Journal Global Economics editor. John, I love the cheat sheet that he was using. That was certainly a moment. But he's right. This economy is extremely healthy and in some ways getting healthier.
Yeah, I mean, I guess I would say he's mostly right. I mean, the strongest in history, you could have a debate about that. But it's true. GDP growth has picked up on a year-over-year basis, about 3% a year. It was a little more than 2% for most of this expansion. Unemployment is very low. Inflation is right at the Federal Reserve's target. I mean, I've been saying this for a while now. We're in a sweet spot for this economy, and the big question is how long can we keep it going? But right now, this is a very strong economy, very strong job market, very strong growth.
Should we worry about what the Federal Reserve does with the meeting coming up next week, John, that they overshoot? Because it seems like the way the bond market was reacting this week, where you had a longer-term yields going up a little bit north of that 3% mark, that it seemed to be sending, the bond market was, that they don't think the Fed is really going to overshoot and slow or damage the economy at this point.
Well, you know, I think the Fed is, we've pretty much priced in 2 more Fed rate increases this year, one next week, as you say, and then another one probably in December. You know, I actually think the stock market could be primed for a rally going into next year, because the Fed has got to be looking at this bond market that you talk about, a 3% yield, and asking itself, well, how much further do we have to go raising interest rates? You know, they're going to be a little over 2% next week. They don't want to raise short-term interest rates so much that short-term interest rates are higher than long-term interest rates. That's something called an inverted yield curve, and that sometimes signals a recession. And there are some people at the Fed who are saying that they might be able to slow down these rate increases if that looks like we're getting to that point of an inverted yield curve. If the Fed signals that it's going to stop raising interest rates, the stock market goes through the roof, I think.
Hey, good morning, John. This is Morgan. A lot of the talk, of course, is on tariffs and what's going to happen in this trade war between the U.S. and China. But interestingly, yesterday, the U.S. government actually imposed sanctions on China for buying Russian military equipment. The Chinese are livid over that this morning. So give us a little forecast of what you think is going to happen, what we can see between now and Election Day as it relates to not only the tariff side of China, but what we're seeing on sanctions now.
Well, I mean, on the sanctions front, you know, this president certainly sees American economic muscle as one of his weapons in the global diplomacy realm. And, you know, he has been using sanctions against the Russians, you know, including for poisoning these British diplomats. He's been using sanctions against the Iranians and now the Chinese, and I think we could see more of that. On the tariff front, you know, again, it's an example of the president using American economic muscle to have its way on the political and economic fronts. You know, we just got another $200 billion of tariffs against the Chinese, and all signals are that he's going to go and extend those tariffs to basically every import that the United States makes against the Chinese. We should be clear, a tariff is a tax. It's a tax on American imports, and it looks like we're going to be getting more of that.
And on that note, John, Walmart issued a warning. The retail giant yesterday said it may be hiking prices on certain products with this trade spat with China. And this, of course, as you mentioned, comes after these new tariffs on this $200 billion worth of Chinese goods. There's about roughly half of our imports from China right now have new tariffs on them. And Walmart issued this warning in a letter to the trade rep, Robert Lighthizer, about these price hikes. Do you think that this is a broad headwind for the stock market, or do we need to be careful, or even the economy, do we need to really watch specific stocks on this note of like how individual companies might be hurt by this?
Well, so I'll say 2 things, one about the stock market and one about Walmart. So as far as the stock market goes, you know, with the rally that we've seen this week, it looks like the stock market investors are now at a point where they've priced in a lot of the tariffs that have been imposed, and they're looking past what we're doing on the tariff front. I think as it relates to China, the market is probably starting to price in some good news on a deal with Canada and Mexico on the NAFTA front, you know, possibly with the Europeans on steel and autos. So, you know, again, I think the stock market is kind of primed to rally on any good news on the tariff front. We've been talking about tariffs so much.
Right.
There's a lot of bad news already priced in there. As far as Walmart goes, you know, Walmart you could look at as China's little embassies all over the United States. China is the critical, central supplier of everything that we buy in a Walmart. You know, that's been a bargain for American consumers for a couple of decades. It meant we've got a lot of cheap goods, especially going to low and middle income households. And if we slap tariffs on a lot of what we're importing from the Chinese, that's going to hit Walmart as hard as anyone, I think.
John, that's an incredible point that you're making. But again, I want to raise this before we move on to one final thing. It's almost because the president likes to brag about how much money is coming into the Treasury Department from these tariffs. And this is my own crackpot theory, just bear with me a little bit, that it's like he's taxing these emerging markets as a way to raise revenue because he is focused on actually at least trying to pay down some of the debt and take a hatchet to some of the deficit. And it's as if he says, hey, I want to raise revenue, let's tax these nations who aren't treating us very well, rather than, say, raising income taxes here in the United States in some way.
Well, so let me say two things. One about revenue, and then the other about this idea of taxing emerging markets. On the revenue front, excise tax revenues have picked up a little bit, but they are a tiny, tiny fraction of the revenue that the United States government brings in. The president has tweeted that we're going to pay off the debt with the tariff revenues that were coming in. That's just not true at this point in time. You know, our deficits are rising. We're looking at trillion-dollar deficits within a couple of years. That's probably the biggest risk to the economic outlook, is how big these deficits are getting. So we would have to increase tariffs by a heck of a lot more for that to have any kind of impact on the deficits, no less the debt. In terms of who we're taxing with these tariffs, you know, it does hit foreign exporters to the U.S. to the extent that it affects their profit margins, but it's also taxing American consumers and American businesses because those tariffs get put on at our borders and get passed on to consumers. The Walmart case is a perfect example of how the tariff gets passed on to an American consumer. So it's not just emerging economies themselves, it's Americans back home.